All right, I have some questions for the audience. How many people here have or are starting your own company? Started, have once started? And how many of you are thinking about starting a company or working someplace else now, thinking about it? You don't want to let your boss know, so you're not raising your hand. How many of you have raised money to start a company before? Okay, smaller number. And how many people here live in Silicon Valley? Not a few, not a lot of hands. Okay. My name is Travis Cross, and I have a background in cryptography. I have worked on large-scale VoIP networks, and I've been the CEO and CTO of companies both, which have been bootstrapped and have been funded. Right now, I'm a partner in a venture capital fund called Molnar Ventures, and we are targeting cybersecurity in Europe. And so what we're going to be talking about today is two kinds of companies that are bootstrapped and companies that are funded, what the differences are and why you might consider getting a company funded, how you get a company funded, and what the process looks like. So a company that's bootstrapped is a company that you are starting with your own money and the revenues from the ongoing operations of the company. A funded company is where you're using other people's money. And so what if, when you were starting a company, you had a way to accelerate its growth? You could do more than just what your own resources were. You could be more sure about the outcome. Well, in sports, if you're the Russian Federation, we might call that steroids. But in finance, we call that other people's money. And that's what you can do when you start a startup, is use other people's money to accelerate your growth. And so let's talk about some of the pros and cons of raising money versus doing it the bootstrapped route. So there are some downsides. If you're raising money, then you have less ownership of the company. So you own less of it, but what you're getting is some money in exchange for that. There are also limits to your control. You have some limits on how and when you can sell the company. You have board members now, which means that you're now reporting to others. And so if you started this company because you wanted to work for yourself and be free and have nobody to answer to but yourself, now you're bringing back in people that you need to answer to. So why would you do this? What are the pros of raising this money? Well, one thing is speed. So how many people here have been running a company 5 years or longer? 5 years or longer, you've been running a company. I have. And how many of us have $1 billion in our pocket by now? $1 billion. No, none of us, unfortunately. Well, that's the opportunity that venture capital gives, is speed, so that in 5 years, amazing things can happen because you're using that leverage. Scale is also part of it. If you're going for international expansion, if you're going for hard problems, then the venture capital comes into play because you need it to get out in any reasonable timeline. And resilience. I think this is the one that people take for granted or don't think about, is that when you're operating a company that's doing less than $5 or $10 million a year, something can come out of left field and really screw up your day. And you don't have a lot of resilience against that. When you're operating on your margins and growing out from your own revenues and you get a lawsuit or the market changes or Google or Apple step on you, then it can be really hard to recover because you just don't have that sort of margin. And the final thing, which goes back to working for others, is accountability. Is that the downside is that you're now having to talk with other people about your business, but that's also the upside, is that every 3 months you're having to check in and say, well, here's what we did in the last 3 months. And that can actually help all of us to get more things done. So on balance, I think the one thing that it really comes down to with raising money is that the downside is limited, but the upside is not. Is that if you raise money to start a company, you're able to go faster, you're able to hire more people, you're able to really move and make more effect on the market. And if it works out, then you make a lot of money. And if it doesn't work out, then whose money did you lose? Not yours. So the downside is limited because you can only go to zero, but the upside is very, very high. So let's talk a little bit about the kinds of other people's money that are out there. So the first is banks, but banks don't really lend to startups. They want to see lots of stuff, things that they can take if it doesn't work out, lots of evidence. It's not really good for this kind of company. For their friends and family. Lots of companies we got started by raising money from friends and family. But then if it doesn't work, whose money are you losing? Friends and family. There are also startup accelerators. These are for early stage companies that need a lot of advice and a little bit of money. In the back, William. Oh, okay, you got it? We lost the video there for a moment. Okay. Accelerators, they help people who are early stage. There are also angels. Angels are people typically who have made money in startups before, people who are technologists and are now looking to invest in the same market and in some sense give back to the community, also to, of course, make a buck by trying to invest in the next big startup. And then there are venture capitalists. Venture capitalists are professionals who do this for a living, who invest other people's money themselves. We'll talk a little bit about that model. And then there's private equity. Private equity is what happens when you are massively successful and you need financing towards the end of your startup career. The key thing to take note here is that this all falls along one continuum, which is that once you get into that accelerator, angel, VC path, you're committing to a certain train of events that what accelerators are looking for are companies that they can get financed by angels and VCs. What angels are looking for are companies that can get financed by venture capital. What they're all looking for is something that's going to get acquired, get bought by a private equity company, or go to an IPO. So what kinds of companies should raise venture capital and what kinds should not? The key thing is a company has to be scalable. What a venture capitalist is looking for is a company that you can pour money in and get more results out the other side. And so what's scalable mean? It means that you have a process worked out so that as things go along, you get this nice exponential curve. And the neat thing about exponential curves is that they are almost scale invariant. So if this is the curve at year 2, then this is the curve at year 3 and year 4, and this will eventually level out. But if you're a company like Uber or Facebook or Google, it levels out at a very high point. And so this is what investors call a hockey stick curve, because it has this nice shape that means everyone is getting more and more happy year after year after year. The other thing that's great for venture capital is where something sounds like a bad idea. All of the great companies out there, lots of them, sounded like really horrible ideas. Airbnb, who would have thought? You want to stay on somebody's couch and have them serve you breakfast in the morning and pay them for it. And so lots of these companies sound horrible at the beginning, but they have to. Because if the companies didn't sound bad at the beginning, then there would already be somebody else who's doing it. And it's not that competition is a bad thing, it's that being commoditized is bad. And so if it was so obvious, then that means that it was obvious a long time ago. And there's already people in that space, there's already funded companies, there's already maybe people who have had successful acquisitions, and now the Googles and the Apples are already driving into this space and pouring a lot of money into it. The other exception to this is when something sounds like a lot of work. Something can be a kind of obvious idea, like Uber. Uber's a relatively obvious idea, at least at the time. But there weren't a lot of companies that did it. Why not? It sounds like a lot of work. I mean, number one, it's what's called a two-sided marketplace. It's where you need both buyers and sellers to come together at the same time. So you need the drivers, and you also need people who want to ride, and you need them all at once so that this thing can come together, and drivers aren't just driving around in endless loops. And they have huge regulatory problems. They have to go city to city, spend a bunch of money to incentivize drivers to go out when there aren't riders yet. Things like this are hard, and that's where having that money is actually necessary, and that's where venture capitalists are looking, because we can actually add an edge to something that otherwise would be impossible to come into existence. So let's look at what you should raise and when. There are essentially these stages that we talk about in venture finance. There's a seed stage. These are companies that have not yet proven out what they're going to do, that it's going to work, and that there's a market for it. So there's a really key thing that we talk about called product market fit. And product market fit means that you have this trifecta, which is a product that fits in a market where you know how to sell it and you know how to market it. And the sales, the marketing, and the product all work together so that you have a repeatable process for selling this. That it's not just the founders had a good relationship with a single Fortune 500 and were able to get a good deal in once. It's that a team of people knows who to talk to in wherever they're going to sell this. They know how to position it in the marketplace. They know that the product is exactly something that addresses a burning need of a certain kind of customer. And when you have all of these things working together, then you can add more money, you can add more salespeople, you can add more developers to get more features, to expand out laterally in the market. And that's product market fit. And so seed stage companies don't typically have this. That's why they're seed stage. They need money so that they can prove out that process, so that they can establish the sales process, so that they can build the product. And then once they get to that point and start to demonstrate initial viability, initial product market fit, now you're talking about a round A company. This is really the core of early stage venture finance, which is where you have a company, it's got some initial really great traction, it's got some proof, and it needs 5, 10, maybe even $15 million for a round A investment to take it to the next level, which would be a round B investment where now you have product market fit at scale. You've really demonstrated that this thing is going to work. Now you need to start talking about taking it around the world, expanding out into other verticals, and really starting to put the pieces together to win a big section of the market. There are other rounds. You can go round C, D, E, private equity rounds. These are where things are really working well and the company's hitting its marks. So let's talk a little bit about how VC works, because this plays into the incentives and it's what you need to know if you're going to raise money from venture capitalists. Venture capitalists like us, we raise money from limited partners. What that means is that there are LPs out there, as we call them. They're pension funds, they're endowments, they're wealthy individuals. They're people who have money and need to put it somewhere. And if you look out across the marketplace right now in bonds and other equities, it's difficult to get returns on an ongoing basis. I mean, there's the public equities market, but that's, nobody wants the average. And if you just want to stash away money and put it in bonds, you're going to lose money right now. Real estate's been an up and down investment recently. Where else can you put it? And this is where venture finance really comes in to give people another option. And that option is to invest in companies that have the potential of changing the world in the future and becoming huge companies where these LPs can see large returns. Funds last for 8 to 10 years. That sounds like a long time, but in fact, venture capitalists invest over a 4 to 5 year period where they're out looking for startups. Part of this is to spread the risk across market cycles. If you were investing in 1999, you probably would have had a really bad year, and 2000. But if you were still investing in 2001 and 2002, lots of those companies went on to become really great successes. And it was a great year to invest. And so spreading that risk helps out. The other thing, of course, is just finding great startups. You look at the industry numbers, and typically, as a venture capitalist, we need to talk to 200 or more companies for an extended period of time before we're going to find one really great investment. A venture fund will make 10, maybe 15 investments over its life. Out of those 10, we'll say 10, you're going to expect 4 to fail completely, 3 to 4. 3 of them might return capital. These are what venture capitalists call the walking, living dead, the undead. What it means is that if a company is just going along, it's difficult to kill, but at the same time, it's not going to move the needle for the venture capitalist. And then 3 of them you would expect out of the set are going to win big. The important thing to know if you're one of the companies being funded is that this is what venture capitalists are looking for, is evidence that you're going to be one of these 3. Because it's these 3 that really move the needle. And in fact, out of these 3, typically 1 or 2 are going to be the big wins that push the numbers. And when you think about it and you do the math, that means that these 2 or 3 companies need to make up for all those others that aren't moving the needle. And because of compound interest over, this is a 10-year fund, that means that a fund like this needs to return about 3 times the money that the limited partners put in. So these 3 companies are going to be responsible for making up that big win. And that's why the venture capitalists were so interested in looking for companies that have that potential to scale and have that hockey stick. Extra zeros make a big difference if you think about it and you do the math and you think, what if I were to invest in a company like Facebook or Google versus a company that, maybe only became worth 100 or 200 or 300 million dollars? I mean, it sounds okay if you've got a company that's worth $100 million. That's a pretty good company, right? But Facebook adds 3 more zeros to that. And so it's really important to find those companies, and that's also the sort of company that you want to be if you're looking for funding, is at least having the potential to go really big. Obviously, not all companies do. Plenty of companies have great successes at 200, 300, 400 million dollar exits, but there has to at least be that potential to take on a big market. The reason for this is that at the end of this 8 to 10 year fund, the venture capitalists, we need to return the money to the limited partners. So we need a liquidity event. We need the company to be sold. We need it to be sold to private equity. We need it to be sold to an acquirer or to go public to make that asset a liquid investment. And when you look at this, you can start to see all the incentives that play in and what a venture capitalist is looking for. So this is the behind the scenes detail, so that when a venture capitalist is telling you one thing and putting you off or telling you this, you have to look at what are they doing. They have to raise money from LPs themselves. They have to report back to someone else, and it's that step that drives the incentives of how they operate. So what do venture capitalists look for? They look for that product market fit. They look for the evidence of it. But they also look for the potential for the startup to win the space. A company could have a great product market fit on a product that just isn't that valuable because it's not that scarce. It's something that a lot of other people are doing. I mean, if you open a barber shop, it's going to have great product market fit. There are people that need their hair cut, and you're cutting hair, but that doesn't make it a great investment. And so it has to be a space that a company can win. Now, you could have a startup like Great Clips or something that has a model for changing it where they're going to win the market and take it away from other people. And that could be an interesting investment, but it's having that angle where you're going to be able to dominate a space. The other thing is that it's a worthwhile market. Just fundamentally, is it a market that's worth winning? There are some things where you can win the space, you can have a great product, but at the end of the day, that market segment is only worth $50, $100 million, something, and it's just not big enough to support investment. And finally, we're looking for a competent team. We want to know that the team has a background and can actually execute on this. But honestly, a lot of this is demonstrated by the evidence that the team has done a good job to date of building the company to where it is. What's the fundraising process look like? Well, the first thing is to get noticed by a venture capitalist. So finding introductions, cold calling them, whatever. Cold calling usually doesn't work, but it does work on some smaller venture capital firms or newer ones that don't have their own deep networks yet and are interested in hearing from companies that are reaching out. Talking with the venture capitalists, giving them evidence, showing them why you believe in this market and what you've done, and then getting a term sheet. So this is where a venture capitalist says, hey, we want to do business, and here's the terms. This is what we're going to value your company at. Here's the amount of money we put in. And you negotiate. Finally, when you've signed the term sheet, the venture capitalist is presenting it, you sign this term sheet, the venture capitalists, we're now going to do due diligence. This is simply validating the assumptions that we've made, looking into the market, looking into what the company that you've told us, and making sure that everything checks out. Finally, you get the money. That's the exciting part, right? You should also, of course, through this process, be looking at evaluating the venture capitalist. This is going to be someone who's going to be on your cap table. They are going to be an owner of your company. They can prevent you from selling your company. They can interfere. They can fire you, maybe, depending on the terms that are negotiated. They're going to be at all your board meetings. You don't want to be working with someone for the next 5 or 6 or 7 years that you don't want to be working with. One thing venture capitalists advertise, of course, is providing advice. We see a lot of startups. We have background. We're able to pull in and pay some really great advisors, people that have, for example, in our case, have run major security divisions for major telecom companies, or people like Phil Zimmerman that have a huge background in the industry. The other is connections. Venture capitalists can often get you connected to customers or others. And in the later stage, when you're raising money from private equity or round B, C, D, a venture capitalist is on your side to try and get you the best deal with later investors, because now they're sitting on the same side of the table that you are. But I think more than any of those things, the correct thing to look at from the perspective of a startup is twofold. One is alignment, is making sure that the venture capitalists, the kind of market that they're going for, where their fund is, and how they're looking at the space and looking to help you is aligned with your vision of it. Because if they're going one direction and you're going another, this isn't somebody that you're going to want at all of your board meetings. And then finally, motivation. Everyone wants to get funded by Sequoia or the big names out there, but you also have to look at, are you dealing with somebody who's really going to be motivated to help your company succeed? And a smaller venture fund or a newer venture fund can often make the difference in being a team of people who's very highly motivated to help you out, because you're not just another number, you're actually going to be what makes that fund successful. When you're going through this process, one important thing to look at is how much money to raise. This is going to be something that you're presenting to the venture capitalists and saying, what do you need? And contrary to popular belief, you don't want to raise as much money as possible. The problems with that is that you get diluted. You want to raise as much as you need for the next state transition. So when we talked about those stages, seed stage, round A, round B, you want to be able to make sure that whatever you're raising, you're able to hit that mark to move up to the next level. If you don't do that, you'll get diluted, and you'll also get this thing we call negative signaling. This is where, let's say you raise too much money and you're able to get to something in your round A, and you're able to demonstrate things out, but you're not quite past the round B stage. But now you've raised a bunch of money. And so now when investors are looking at this, their standards are far higher because they see that, well, you raised $20 million, you should be further along. And so that creates some significant problems. You want to raise just enough so that you can get to that next stage and be on a trajectory for that next stage. Look like you're on a growth curve and that you've done a lot with very little. And of course, you do want to raise enough to avoid running out of money. The number one cause of startup failure is running out of money. But of course, that's not really the cause. The cause is not having customers or having a bad product or whatever. But the final cause of death is always running out of money. So having enough money not to run out of it is a critical factor. After raising the money, what are the important things to keep in mind? You now may have in your business bank account more money than you've ever seen. So what are the things to do after getting that money? It's using the money to solve problems. If you've been a scrappy bootstrapping company, this can be difficult because you're used to doing with less and taking a long time, maybe take 3 months rather than pay somebody to do it in a week. One of the great things and the key things about venture capital is using that money to accelerate things smartly. And so you use money where money can solve problems, but only problems that need solving. And that's the key, is making sure to focus the money on things that actually accelerate growth, but actually need doing. Because you don't want to spend the money too fast, or you'll run out of money and die. And specifically, you don't want to hire too fast. Hiring is a very expensive mistake to correct. And of course, you don't want to run out of money. You want to focus on your product. And I think there's a really great example of a company who did this, which is WhatsApp. And WhatsApp was so focused on their product that they had Sequoia, I think, trying to beat down their door because Sequoia wanted to give them money. And they just weren't taking their phone calls because every day they were adding at that time something like 200,000 users to their product. And they were thinking to themselves, I could spend today going and meeting with a bunch of venture capitalists, or I could spend a day figuring out how to get it from 200,000 new users a day to 250,000 new users a day. And so that's what they did day after day after day until at the time that they were bought by Facebook, they were adding in the neighborhood of 1 million users a day to their service, and they had half a billion at that time. So that's a very successful start, and they were just relentlessly focused on their product. You look at their numbers when they were acquired by Facebook, and they had something like 55 employees, and 2/3 of them were engineers. The rest were customer support. They were doing nothing else but focusing on the product. They weren't being distracted by biz dev or going to conferences, though you should still, of course, come here, or other things that could throw them off. It was all about building that product because that's what's important in the early stage. The other thing to mention is that so much of this happens in Silicon Valley, but there's a lot that's outside of that. And we saw at the beginning, very few people here are in Silicon Valley, but lots of people are starting their own companies. And so what do we make of this? There are a lot of advantages to Silicon Valley. And in fact, if you go there and you talk about starting companies anywhere else other than Silicon Valley, people will give you this, this look like, oh, poor child. Because they see so many advantages, and that's all that they can see is that companies have to be started there. The trouble is that it's very expensive. It's become very expensive. It used to be there was a reason why it was started there, is that if the land was cheap, you could do a lot of things. Now it's a very expensive area. It makes it hard to start certain kinds of companies. It's also not possible for everyone. And I think this is the key point, is that there's a lot of great people in Europe and other areas of the world that simply can't get the immigrations, can't get their commitments, can't get to Silicon Valley on a long-term basis. And I think this is actually starting to change now, in that you look at what's happening macroeconomically, and so much of the new innovation is now being applied in places outside of the United States. China, India, these places are coming up from poverty. They're bringing millions of people out of poverty who now want a lifestyle similar to ours. They watch our media, they watch our movies, they know how good life is in the West, and they want those same things for themselves. And so as these innovations are used more in other parts of the world, people are going to start innovating in other parts of the world more than they are today, and start needing to grow and scale those markets. And scaling has really been the issue in the past, is that there's always been great innovation around the world, but until countries really start climbing on this massive growth curve like we're seeing now in many places throughout the world, it's hard to scale and apply those innovations. And that's the important thing, and that's what's changing now, where companies all over the world now have this opportunity to address non-US markets. Because if you're only addressing the US, then it kind of makes sense why Silicon Valley, you just go there because you're selling only to the US market. But now there's so much in the way of other opportunities that you are starting to see more innovation coming out of Amsterdam and Berlin and London and Spain and other places that were traditionally not startup hubs, but are now seeing some key successes and some key early indicators that there's going to be change. And so there hasn't been a great ecosystem in the past in Europe and other places, but there's starting to be now. And there are some really great indicators of this. There are new venture firms forming, including ours, that are addressing the European market, and we see a lot of great things coming out of that. And so with that, thank you, and we'll take questions. He's got the mic.
We're just trying to get the mic turned on at the soundboard there.
Thank you. I'm wondering about the role of public funding. Is that strictly restricted to university research, or is there any way for someone to tap into that, someone who's already graduated, not in a program, doing something for a PhD, and maybe developing the technology for like the benefit of the public in general?
Yeah, so that's an interesting question. In the US, there are grant programs that are not specifically, many of the grant programs are not specifically tied to universities. But it is easier to get lots of them if you're affiliated with one. Probably the easiest path there is to go and get affiliated, not necessarily as a student, but go and see if you can become an adjunct, or work with a professor there who's working in that field and get that institutional credibility behind it, and that makes the grant writing process a lot easier. The other thing specifically to starting companies is that a lot of public-focused funds are investing in venture capital as well, and so you do see some of these limited partners being sovereign wealth funds or innovation programs for particular countries where they're looking to move more startup ecosystem into their country, and so they either do direct investments themselves or invest through a venture capitalist, and you'll see you'll see that as well because they're trying to push the ecosystem forward in their own country or their own locale.
So, because we're 10 minutes.
The Matrix guy, yeah. There was a question.
Was there? I didn't see a hand.
Oh, I thought there was one back.
over there.
Right there.
Two over here. Okay.
Yep.
Hey, could you speculate maybe on why VCs are focusing so heavily on sort of AI security at the moment? It seems to have just kind of come out of nowhere in the last couple of years, and I'm curious as to, what sort of triggered it all off.
I think it's twofold. So there's been, number one, great growth in the cybersecurity space. By the way, I cringe. I used to cringe every time I said the word cyber, if anyone else is cringing here. And then I decided after hearing enough other people say it, including people that I thought would have cringed, them saying it, that it's crossed over the chasm, that it's too far along and there's no other word for it now. So I'm getting over my own cringe factor. Anyway, that space, the information security, cybersecurity, whatever you want to call it, space, has just been on a huge upturn after the Sony events and the Target events and the Home Depot events and the Democratic National Convention events and all sorts of other things that have caused massive embarrassment and loss of confidence in these companies, where now this topic of information security is in the boardroom. I mean, it's a topic where now it would be negligent for these companies not to address it. And so they're spending big on the space. And so there's a lot of opportunity there. And then I think to the AI side, that combines with the great work that Google and others have been doing, really pushing forward that AI space and really finding that, hey, those techniques from 1988 work really great if you have huge computer systems. They didn't work in 1988, but they work now. And so we're rediscovering, we're having a renaissance of a lot of these great ideas, pushing new computer power into it. And so you have this AI space that's huge in its own right. And then you have security that's on a huge uptick as well, just because of the money that's there now, and these things are coming together.
Also, investors are lemmings. Okay, last question here.
Do you see any room for companies that people want to keep and grow, where their goal isn't necessarily? We had a telco that our goal from day one was to sell it, and that was fine. What about a company like IBM, where your goal is to keep it, grow it, and live off the residuals?
Well, but IBM's a public company, so that is selling it. That's having a liquidity event.
Maybe that's not the greatest example in the world, but something you want to keep and hold on to and not sell, nurture.
Yeah, I mean, so the trouble is that any investor needs a point at which they can liquidate that investment and hand it off to someone else who wants to hold it maybe for a longer term. And so it's not impossible. I mean, if you look at Dell, for example, Dell was a public company, and then Michael Dell used private equity to help him buy back the whole company and now run it himself and with his private equity backers. And so there's ways to do that later on if you have a successful company where you can bring in someone like a private equity fund that's wants to be involved with the company for a long time and can help liquidate out the earlier investors who don't want to be part of that anymore. All right. I think that's it. Thank you all.